to Dr. Simon Jowitt, Professor of Economic Geology.
Thanks, Josh. I'll just get my screen shared here. Bear with me a second. I'm assuming everybody can see this okay? Yep. Silence means yes, so I'll take it as that. Okay, so tonight I'm going to be giving a bit of an overview of COVID-19 in the mining industry. It's kind of certainly a hot topic right now, kind of a large topic. But it's obviously a developing topic, but I'll hopefully give you some insights into what we think is going on in terms of metal markets, metal supply and demand, and what implications that has for the mining industry in the not too distant future. I've got a disclaimer, as all good economic geology mining talks. I'm not an epidemiologist. I'm not strictly an economist. I do know quite a lot about mineral economics, but unfortunately I also can't predict the future. If I could, I wouldn't be a professor at UNLV. I'd be rich in the Bahamas or somewhere. But equally, I've been collecting this data for a while. I had a publication out in the SEG Discovery, a newsletter, on basically using a kind of first round of these data. They're still changing rapidly. We don't exactly know where we're headed, so we will, this is all fairly speculative, but there's certainly some trends emerging from the data we've seen so far. There's some positives, gold being one of them. As people in Nevada, you probably noticed, the gold price has gone up a little, somewhat, since this thing began. There's some clear negatives, and also the length of time the situation around COVID-19 is going to go on for is hugely uncertain. So this presentation is certainly speculative. Happy to discuss online, with social media, email, however you want to contact me, even phone me if you want. There's also, as I say, the SEG Discovery paper, and I gave an earlier version of this in April for Ore Deposits Hub. If you haven't seen Ore Deposits Hub, it's worth checking out. It's basically a whole series of experts in economic geology talking about economic geology. And the main thing outside of all of this is to keep safe and healthy, but you've all been hearing that since March, so I'm not going to dwell on that. What do we know? We know that metal production has grown throughout the 20th century, independent of major events of any type you want to throw at us. These events have either caused hiatuses or change in focus of metal production. You can see this in records back to the Black Death and beyond. So there's been an awful lot of metal production that seemingly the overall trend has not been impacted by these major events, maybe even been impacted positively in some ways. COVID-19 might represent a different challenge. I'm going to outline 3 potential scenarios for metals in the mining industry associated with what we're seeing in metal supply and demand. We know that most mining is continuing on as normal or slightly reduced capacity. It's one of these industries that's been considered essential, but the impact on demand is a different matter. And we're seeing variations in that, and I'll discuss that later on in the talk today. But yeah, what we saw in April, like 5 years ago now, it feels like, was demand from China and other areas increased after their lockdown lifted. So China relaxed certain things, industry started again. Other demand was reduced with lockdowns in Europe and North America. The question is, where are we now? Are we back to where we were before? Has demand increased? Has demand decreased? And how's this entire situation affected different metals? We're seeing demand seemingly not back to pre-pandemic levels yet, and I'll discuss that a bit later on. And interplay between metals is also going to have an impact on all this, because if, for example, the demand for metal A decreases, that means that also the supply of metal A decreases. Any byproducts of that metal are also going to be affected. So we might see interplays between different metals, and obviously that's going to have an impact of some sort down the line. We've seen quite a bit of volatility. It's calmed down a bit in terms of metal prices, including in safe havens like gold and other precious metals. And what we think we're seeing, and I give credit to Rod Eggett for helping develop these ideas, is basically 3 main scenarios for COVID-19 impacts on the mining industry play out at the minute. I'll go through all of these later on. We're seeing persistent supply chain disruption affecting some metals, other metals being affected by slow demand growth, and we're seeing safe havens, precious metals essentially behaving slightly differently again. Not all metals, not all parts of the mining industry are being affected the same. So key things to think about, key things I'm going to talk about is what's impacting metal supply and demand during COVID-19, how's that going to affect what's going to happen afterwards, how's changes in both metal supply and demand lining up, because they're being affected in different ways, and as I say, what about afterwards? And the key here is kind of longevity, how long lockdowns or whatever they want to call them now, second waves or third waves or peaks or troughs, all these descriptors, how long are these things going to last and how they're going to affect things as we go forward. Are we going to see second waves? Yes, we are, because we've seen them already, apparently. Can and will they be managed? Are people going to bother managing them? How are economies going to be how affected by any mitigation effects? And how are demands for metals in these countries going to bounce back afterwards? We know demand is going to drop through lockdowns. We know that it's going to pick up afterwards, but what rate and what's going to change as a result of COVID-19? I've had a look at previous pandemics and economic crises, done a bit of detailed analysis. You can see that in the Ore Deposits Hub talk on a month-by-month basis. But basically, a lot of this is it's difficult to understand what's affecting what, and that's something that we have an opportunity with COVID-19 to actually understand what is directly controlling metal supply and demand. And I'm happy to discuss further or share some of the data I've got in here. Email me, tweet at me, as I say, just get in touch in one way or another. And this is just a plug. This is the SEG Discovery paper, COVID-19 and the global mining industry, part of a double header with a paper by Murray Hitzman and others from, I can't remember the name of the university in Ireland, but they basically had results, whereas I looked at more metal prices and demand. And some of the things that I outlined here certainly seem to be happening. Two of the scenarios outlined in this paper seem to be coming to fruition, but there's obviously been more development. This was published. And now I'm trying to change the slide. There we go. So what issues has the mining industry faced to date with COVID-19? Certainly personnel. We're seeing limited transport of people. If you look at Western Australia, basically the state has said you can't come in if you want to, and that's restricted fly in, fly out work. Certainly international travel has also been restricted. Supplies to mine sites have always been restricted somewhat. When basically mitigation effects have actually reduced mine site capacities. Governments have reacted differently. Some governments have forced mines to shut. We saw that in South Africa. We saw that in Mexico in a limited way. We've also seen governments try and force mines to remain open despite challenging economics. A good example in Zambia that I'll talk about shortly. Metal demand, both intermediaries, so like concentrates going to smelters, whether a smelters are still open and operating, metal going to end users and prices have also varied in a quite volatile fashion. And the transportation of materials has also been impacted. Concentrate to smelters and refiners because ports have shut, as well as intermediaries. There's alternative transport routes had to be developed. Borders have been shut. All of this has made a very confusing situation, including confusion over whether transport hubs are actually open or not. You can have a look at the paper in SEG Discovery to see some of the things around the port of Durban in South Africa in that regard. So before I actually get into the current data, I just wanted to touch a little bit on the past. There's what everybody calls this an unprecedented scenario, but humanity's gone through an awful lot of crises in the past, and I just wanted to have a look at very briefly at how how humanity's mining has been affected by previous crises. We can divide them into three different kind of scenarios: major global and regional conflicts, World War I, World War II. Pandemics, there's limited data on these, the Spanish flu, but there's a real overlap between that and the effects of World War I, and financial crises, the Great Depression, global financial crisis. Each of these has influenced metal production in different ways, or in some cases it just hasn't. Haven't seen any impact at all of some epidemics, or at least not on a global scale. And the approaches, obviously, to these crises have varied. So resolving these crises have varied. And it's important to think about how our approaches to COVID-19 are affecting primary industries and the metals those industries produce. Equally, can we actually compare, from a mining viewpoint, previous pandemics to COVID-19, or should we compare to conflicts? Both actually remove personnel from the workforce for different reasons. Both actually create differences in supply and demand. So, what's the best comparator? And should we even bother trying to compare, or should we just think about what might happen in the future? So why would we compare COVID-19 to conflicts rather than pandemics? As I say, basically it's a change in demand for metals, plus also a removal of people from the workforce. I mean, if you imagine World War I and II, an awful lot of people were not working in mines, they were actually off doing other things, conflict in Europe and the like. So, if we actually think about COVID-19 rather than as a conflict, is this all bad news? If you look at World War II, obviously it completely devastated Europe, had major impacts globally in a whole number of different ways, but also it was followed by 3 decades of above average GDP growth and increased metal demand with reconstruction in Europe and Japan. We're not talking about whole-scale destruction of buildings and things like that in Europe and Japan or globally as a result of COVID-19. But what we are seeing is because, for example, less people have been on the roads, you have seen increased investiture in infrastructure. There's been an awful lot of building going on here in Las Vegas. They've actually been working on roads and the like and doing things that, because of the lessening in traffic volume, might not have been so easy to do otherwise. We might see infrastructure investment in capital and transportation. Certainly there's investment in vaccines and the like. So who knows what else might happen with this pandemic. Potentially this could lead to higher demand and increased metal prices. This is looking on the bright side, but it also could link with efforts to stimulate domestic manufacturing in the US here and Europe as a result of supply security issues, basically where we get our metals from in the future. However, obviously this is long-term. You've got to think about short-term negative impacts, because some of those might be that if demand slumps, some companies in the mining industry just won't survive. Or there may be other things that affect them negatively that I'll talk about. So, to reap any potential long-term benefits, you've got to survive the short term. Anyway, that's enough of that. I'm going to talk about pandemics briefly. I'm going to start off with the Black Death. This is if you haven't seen these are giant cuddly microbes you can buy on the internet. You too can collect things like the Black Death, and I believe there's even a COVID-19 one. That's enough advertising. But why are we talking about the Black Death? It's probably the biggest pandemic we know about, but equally it did have an effect on the mining industry. If you look at historical records from Germany and Cornwall, 2 major mining centers, suggest those mines shut down. Quite a lot of the world's supply of metal, actually, certainly in Europe, shut down. The Harz mines in Germany actually shut down for about 100 years as a result of Black Death. We can see that in atmospheric lead pollution. This is primarily from smelters. This is basically going to, here's more or less the present day. You can see the beginning of lead abatement in cars here. This is ice core records going back through history. Here's the pandemic. What happens in the pandemic? Lo and behold, we get a whacking great loss in lead in the atmosphere. Smelting stopped, essentially, or certainly, and that's one of the implications of this. And we can't say for certain, we can't actually talk about impacts in any detailed way, but we can certainly say that demand as a result of this pandemic certainly decreased rapidly. Demand for metal or people just stopped mining, probably because of the high death rate with the Black Death. But the picture's not all doom and gloom. After this, you actually saw the economy rebound, and actually people were wealthier after the Black Death than before as a result of some of the social and other profound changes during this pandemic. I'm not saying let's hope for something like the Black Death, COVID to turn into the Black Death. That wouldn't necessarily be good, but certainly we can say that pandemics like this did have a major impact on the mining industry. If we look at the other big one, the Spanish flu, influenza A virus, H1N1, if you prefer. What we know about this, we know more, we have more data, certainly infected up to 500 million people, 17 million to 100 million deaths. There's a lot of uncertainty there, but it certainly killed a lot of people. Probably originated in Kansas, that's the latest research, but the Spanish flu, because of the World War I censorship, Spain was the first place to actually report it in any meaningful way. And there's a really good report by Garrett, talks about this influenza, suggests implications for a future pandemic like COVID-19. If you go to the St. Louis Fed Reserve, you can actually download it for free and have a read. But one thing is we can see certainly that we talk about mortality and how it affected people. It's hard to distinguish an economic impact because it's so close to World War I. you have the waning days of World War One. How did, what's the major control on the metal mining industry in this case? Is it World War One or is it the pandemic? And it's probably the World War. Just to give you an idea, this is the Dow Jones Industrial Stock Average. People talk about share prices a lot, and I'll say why we don't really want to think about those in too much detail. But what I want to just show here is here we have 1918, 1919. This is the end of the First World War. We have a recession here, reflect at the end of that World War rather than reflecting of the impact of the pandemic. There's not much change in stock prices, especially when you look at the Great Depression here, where you get a huge drop off in share prices after a large buildup. It must have had an impact of metal production, but it's somewhat unclear. It's the same with other modern major pandemics and epidemics. Unless you have real detailed data, then it's very difficult to distinguish the effects of a pandemic compared to everything else. Somewhat, we have that data for COVID. I'll show you shortly, but this is where we start to think about, well, okay, what are the long-term and short-term effects going to be? There's only 1 year of the pandemic. The mitigation approaches used didn't hugely impact mining. However, change in demand and deaths almost certainly did. There was already a labor crunch in mining operations because men were conscripted to fight, hadn't returned from Europe during the initial stages of the Spanish flu. So you had increased demand from war effort, decreased demand from other areas. So what we think might have happened is this basically supply balancing demand, especially at the waning the waning part of the World War, where industries are actually being well supplied by materials because the supply chain systems had worked themselves out. So all of this makes the impact somewhat unclear. We might need more granular data to look at this rather than saying, well, certainly to look at the mining industry. So what we can say is, there must have been some impacts, but we're not exactly sure. Maybe certainly on a medium to long term scale, those impacts would have been minimal compared to the larger impact of the World War and the end of the World War. And also, it's important to think about differences between 1918 and now, 100 years difference. We live in a more globalized society. Markets, economies are intrinsically linked. We get social media and things like that. We know what's going on everywhere. Medicine has significantly improved. But, if you think about the metal mining sector, a lot of mines don't smelt things in country, never mind on site anymore. They send things overseas, and that's all linked with globalization. But it's interesting to think about if COVID-19 had happened 15 years ago, infection rates would be higher because people needed to move more. The advent of the internet and, only 8 million households in the UK had broadband 15 years ago. Now, the vast majority do, and that's just made everything a lot easier. It may not have mitigated all the effects, but certainly we would probably have seen higher infection rates. This is just I mentioned stock prices. Here we have just a list of epidemics, the month end. These are the 6-month and 12-month changes of the S&P index. Basically, what we see here is we've got our epidemics. When they ended, HIV obviously carried on, but certainly our understanding of the disease was significantly improved by this date. But the main thing to take away here is that there's no correlation between these epidemics and pandemics with share prices. But that might be because share prices are not a good index of anything. Paul Samuelson, who's better at economics than I am, basically said to prove that Wall Street is an early omen of movement still to come in GNP. Commentators quote economic studies alleging that market downturns predicted for the last 5 recessions. It's an understatement. If you use Wall Street indexes, they predicted 9 out of the last 5 recessions. In other words, looking at share prices is complete bullshit, and it's mistakes for beauties. In other words, the S&P 500 might be newsworthy, but it isn't a good indicator of the health of the economy. And certainly in the globalized society, the world we live in, there's other influences outside of our own economy that may have significant effects. Equally, we can look at metal prices and production during previous pandemics, but the picture is not entirely clear. There's the overprinting of other events, super cycles, the advent of China, the increased demand from various parts of the world. There's always something affecting something else. And so to actually pick out the effects of previous pandemics is pretty difficult. We might have a chance with COVID-19, and I'll show the data shortly. This is just an example. Here we have metal production. This is copper price and copper production between 1900 and more or less the present day. We've got major events: World War One, huge spike in copper production, a little spike in copper price. Little spike in copper production. Here's the influenza pandemic, the Great Depression, the big slump in price, a little slump or a large relative slump in production. But you can see when we get through to close to the present day, World War II didn't have a huge impact on copper prices, but certainly saw an increase in production. But when we get, as I say, close to the present day, the 70s, the 80s, what you see is things like the global financial crisis, the OPEC oil shock, and things like this actually having larger effects than, say, pandemics or even conflicts. Some of these things are pretty short-lived, like SARS, pretty easily dealt with compared to COVID-19. But basically what we're seeing is that there's more economic crises have a larger impact on copper price, on other metal prices and production than is the case for pandemics. That might not be the case with COVID-19 because of the large economic impact that this pandemic is having. So that's stuff in the past. It's about all as clear as mud. Basically, we can say a few things, but we're not actually, we can't say anything definitive by looking at the past for once in geology. But what we're going to do is we're going to leave the past behind and look at more recent events. Basically, what happened between January 1st, 2020, March 2020, when the pandemic really took hold in the US and other places, and now. I've got a few. This is, I'm not going to go through this in detail. This is again from the SEG Discovery paper. Basically, this is a table. Here we have countries, the metallic, mineral, and coal production, the MCI score, which is basically an indication of how important mining is to that country's economy, and their production value is a percentage of GDP. That's all basically saying how important mining is to the country, the major metals they produce. And this is basically whether mining could continue, and whether business operations in the country was restricted, but then whether mining could continue. All these countries restricted businesses, they locked down in some way, but the vast majority also allowed mining to continue in the majority of cases. Mining was considered essential, probably because it's important to an awful lot of countries' economies. There's different mitigation effects. Some countries mitigated on a countrywide basis, others on state and province, and there's notes here. But I'm not going to go through this in detail. The main thing I'm going to highlight is that for all of these, mining was allowed to continue in the vast majority of cases. This is as of June. There's been some changes, and obviously individual mine sites and operations could make their own decisions in some cases. And the same here, this is just going on down to countries which are where mining, it's not a huge amount of value, but certainly has a real impact on the country. So we've gone from high value mining sectors to very important mining sectors. In other words, the sectors that actually shore up the economy of a country. And again, what we see is the vast majority of countries allowed mining to continue. One example being Tajikistan, which basically didn't have a problem because they didn't have any COVID, apparently. So that's all well and good, but I mean, then we start to get into the kind of more nuanced information about what happened and where, and this is where because different countries, different provinces, different companies all reacted differently. This is where the picture becomes slightly unclear in some cases. So we have a couple of examples. Quebec miners shutting down operations in March after a COVID-19 government order. This is a Pumpkin Hollow in Nevada, actually basically was allowed to continue. 2 mines, 2 different places, 2 different outcomes as a result of COVID mitigation. South Africa shut down for 3 weeks, then went on to 50% capacity, just because the mining industry is so labor intensive in South Africa. They basically shut it down for the first time in 150 years, and just because the number of people involved and the way they work in South Africa in the bushveld and the Witwatersrand and so on. This changed to 50% capacity afterwards because I think that the country realized what impact this was having on the South African economy. But one thing that happened globally is that if you take the bushveld out of circulation for palladium and platinum, what happens? You get supply, demand exceeding supply, and all of a sudden prices start to jump. And that didn't just happen with palladium and platinum, it happened with a range of metals, as we'll see shortly. We also got volatility. So this is the 31st of March here. This is the day after. So this is basically gold remaining commodity to own, gold reaching an all-time high, $1,900 an ounce. We're expecting basically this, this is all going to continue. Gold price will continue going up. The next day, Russia decides to stop buying gold, and then all of a sudden we get a $40 fall in gold price. So there's all not volatility because different countries were doing different things. That has settled down somewhat, and now we can actually see things have sort of normalized, but then the question is what's going to happen next. Copper production still growing in 2020, going up by 1.9% in 2020. Whether that happened or not, this is again a couple of months ago now. I'll show why there's some uncertainty on this. But then we see another metal, nickel, another base metal, actually taking a big COVID hit. Because basically a contraction in nickel demand. So in other words, we end up with 150,000 tons of surplus nickel, but basically copper production going up, but that may have not been the case, as I'll show shortly. We also see things like this happening. This is Mopani copper mines in Zambia. Glencore wanted to shut because the economics didn't look good. The copper price decreased, disruptions caused by COVID-19 mitigation. The government said, nope, you're going to stay open. Because we need the money. So this is almost moving towards resource nationalism in some cases. And even if you could continue mining, these are cobalt copper mines in the DRC. Usual shipping route is down to Durban. Some confusion and whether the port of Durban was actually open. So they ended up going to Dar es Salaam in Tanzania and Maputo down here as well. So actually developing new transit routes to get their cobalt concentrates and their copper concentrates through to China for smelting and production. We also see, the market's got restless. Basically, we see that 275 disrupted mining operations across the world, even without governments forcing shutdowns. But then also global mining deals values suffering as a result of a COVID-19 pandemic. So in other words, what we see is people being worried about their money. They're not sure what's going to happen, so they stop investing, they stop doing deals, and that we saw that kind of affect all sorts of markets during the early stages of the pandemic. And equally, mining costs seem to have gone up. This was certainly the case for the Ebola epidemic in West Africa, which hit gold supply somewhat. But what we see is a mining capital. We see mining costs going up about 16% due to COVID-19. But equally, it depends on the metal. So if you look at bauxite, bauxite is a slight decline, but that's because a lot of bauxite is mined in areas, or certainly like Australia, where they actually had good mitigation in place, and the mining industry was not hugely affected, like in Western Australia, for example. So again, we just get this picture of confusion of different parts of the mining industry being affected in different ways. And this is somewhat more recently. This is June and August. Codelco shutting down Chuquicamata to prevent a spread of COVID-19 among staff. And also Codelco moving towards automation. So this is the long-term answer to COVID-19, but hopefully how quickly this can be rolled out. People have been thinking about automation for a long time. How quickly it can be rolled out is a completely different matter. But certainly it may give you a drive towards automation in the longer term. So in summary, after all of that, mines are deemed essential businesses by most legislations. We saw individual operations closed as a result of personnel testing positive. Maybe some of the more remote mines that are close to indigenous communities in Canada shut down as a precaution, just change in demand and prices. And this situation continues to change, like Chuquicamata fairly recently. Some areas reopened earlier than others, like China and South Korea. Their industries, if they were paused, they restarted. Increased demand for metals, especially as these countries don't have huge amounts of internal supply for key metals like copper and so on. Financial stimulus is great. I don't mind having $1,200 in my back pocket. It's going to bridge gaps, but it's not going to increase metal demand necessarily. We may need more stimulus to restart the economy if you want to go for a Keynesian approach. But the question is what happens afterwards? And this is what happened after the global financial crisis, which is followed by a sovereign debt crisis. And what's going to happen? Because all these countries are accumulating debt to try and shore up their economies. What's going to happen afterwards? And that's the key question. I don't think anybody has an answer yet. What happens if, like Zambia, governments want to keep operations open, companies do not? Are we going to see resource nationalism as economies become more strained? And what about mines that have gone from care and maintenance to full production? How long a lead time will that be for certain mines? And the question is, how has this all these variables affected metal price, supply, and demand? So before we get into the data, I just wanted to outline or describe the three scenarios we think are happening. The first is persistent supply chain disruption. This is where mining is similar to farming, basically, like earlier on in the pandemic. It's not significantly impacted by COVID-19, but intermediates are. Meat processing plants in the farming sector, smelters or refiners in the mining sector are impacted either as a direct result of mitigation or indirect challenges. They can't get the concentrate, for example. So what happens in this scenario is you get bottlenecks where demand for metals can't be met, maybe leading to an increase in prices. So that's one potentially positive aspect of these scenarios for COVID-19. The second is a slower demand. It's like the retail industry. Production can continue, stock is available for sale, so mining continues, production of metal continues, but demand decreases because nobody wants to buy the metal to make the end products, because nobody's buying the end products. The lack of consumer access, limits in consumer spending, people have less money if they're not employed, and as a result, removing demand. So basically what we see is a drop in demand leading to a decrease in metal prices. And we have safe havens as well. Gold, palladium, potentially platinum, precious metals considered safety investments in tumultuous times. So what we might see then is increasing prices as a result of increasing demand for investment. So the question is, which of these scenarios are we seeing play out? And what you'll see is all three. Let's have a look. The data first. When data are normalized to prices, and I'll talk about metal stocks. When I mention metal stocks here, I mean the amount of metal that's available for sale on the London Metal Exchange. I've normalized everything to almost pre-pandemic, 1st of January, and I've just shown it as a comparator the price of Brent crude. So this is not just affected by COVID-19, but also politics. But equally, the price of Brent crude is oil or fuel is important for mining industry and keeping vehicles running on mine sites. If we look at precious metals, we are back for January 1st, more or less the present day. What we've got is this price index normalized to the 2nd of January in this case. We've got major events. So this is where the World Health Organization mentioned COVID-19 for the first time. They called it COVID-19 here. This is where the pandemic was declared, and this is where everything started to shut down. This is where the US CARES Act was signed, and also more or less coincident with South Africa shutting mining. And this is where South African mining went back on at about 50%. What we can see is, you can see if we look at Brent crude, just slumping down to basically 20% of its value as of 2nd January as a result of various reasons, decreased demand and Saudi Arabia and Russia flooding the market. If we look at palladium, palladium jumps up, then slumps. We have a pandemic declared. Palladium is significantly affected. It's not just a precious metal, but it's also used a lot in the car industry. It's where a lot of the demand is. Demand reduces for cars, demand reduces for palladium. But then lo and behold, you get a jump back up because South African production essentially shut down. And then we get we go back to more or less normal, basically somewhat above the prices we saw in January. So palladium prices actually increased over the last, 9 months or so. Gold is here. This is gold again, gold tracking up, then decreases. The pandemic a little, jumps back up again as South Africa mining shuts down and continues on this trajectory up here. It's a little volatile, but it's still, significantly above where it was on January the 1st. And here's platinum. Platinum decreased in platinum demand globally. Platinum prices are slumped because people are using less diesel vehicles. But what we get is basically a slump down here. South Africa mining shut down, then a gentle increase, but we're still not back up to where we were in January. So certainly gold and palladium, we're seeing prices increase. Platinum, not so much. Look at base metals. Base metals all kind of reacted the same. Copper, we've got copper, lead, zinc, and nickel here. Basically all come along. They all start to slump as the pandemic hits, as demand decreases. They all take a little jump with South Africa mounting a mining shutdown. And basically as things recover, as China and South Korean demand for concentrates increases again, we see basically this trajectory, all these metals following more or less the same trajectory to all coming up here when they're clustering at prices above what it was in January. And if we look at minor metals, we see something the same. We've got aluminum or aluminium, if you prefer, tin and cobalt. Again, all slumping around the pandemic, all slightly picking up around South African mining shutdown. Then all certainly this is tin going up to prices slightly above, the same for cobalt, and aluminum prices are basically where they were in January. So, the question then is, okay, well, prices are either above or about the same as they were in January. So is the situation basically normal? And one would say maybe not. Because what we have here is we have a slightly different diagram. We have copper, zinc, and nickel prices in the solid lines here. See, they decrease and they all increase. This is all normalized to everything as of 2nd of January. But what we have here is also marked on as copper, zinc, and nickel stocks. This is the nickel, copper, and zinc that's available for purchase. If you look at London Metal Exchange, this is the stuff they have in their warehouses. So if you think about it, if obviously we have a supply and demand situation here and prices should reflect that. So in other words, what we have is copper stocks increasing as demand slumps. But then as basically we go back to sort of normal around here, mid-May, the copper stocks decrease and actually copper stocks are now lower than where they were in January, maybe as a result of shutting down of mines like Chuquicamata for a period. Zinc, let's have a look at nickel. Nickel kind of plateaus at about 50% higher than where it was in January, and we haven't seen much change. Zinc is an interesting one. So zinc has basically jumped up. Now in warehouses for sale, we have about 4.5 times the amount of zinc we had in January. So there's been seemingly there's been a slump in demand for zinc, but the interesting thing is that the zinc price hasn't reflected that yet. So what's going to happen with zinc? And why are we seeing these differences in copper and zinc? And I'll talk about that shortly. And given where we are, we also need to think about gold, what's happening in the gold markets. What about gold demand and supply? There's only quarterly data available for gold. But what we've got here is, I'll show you a few examples, if I can get this to work. Here we go. So this is gold demand. It's quarterly data going back to 2010. It gives you an idea. This is the gold price. This is total gold demand. This is jewelry. These are central banks. This is investment, and this is technology. If we look at the last two quarters, quarter one and quarter two of 2020, this is the price going up as a result of the pandemic. Total gold demand is decreasing, which is interesting. But what's happening is we're seeing essentially jewelry demand decreasing, investment demand increasing. So that investment demand is probably what is driving the gold price increase. It's not that gold demand is increasing, it's that people are investing in gold. And maybe that gold isn't available for recycling as later use as jewelry often is. If we look at gold demand and supply, again, this is the gold price up here. This is total gold demand. This is mining production, which you can see slumps associated with the pandemic and moving into more or less the present day. We see a bit of variation in gold hedging. I'm not going to get into hedging, but the interesting thing here is this is the surplus deficit. So this is where the production is exceeding or not meeting demand. And at the moment, we're seeing certainly we're producing more gold than there is demand for, but that is actually decreasing as we're moving towards the present day and towards the pandemic, towards the kind of middle of the pandemic. So we're seeing increased investment, decrease in use in jewelry, and a decrease in gold surplus available for purchase and use. And this is just showing a bit more detail. This is the gold surplus. The price is on this axis, gold surplus over here. If you look at zero, this is where supply and demand actually meet. We still have an excess of supply, but that excess is decreasing as the gold price increases. but it's not decreasing by a huge amount, and we didn't see other changes in price reflecting excess or deficit amounts. So it might just be that people are seeing gold being bought as an investment, as a safe haven, and that's what's driving the price up, rather than any significant change in demand compared to some of the other fluctuations we've seen in the past. Gold production prices, gold production costs are also seemingly increasing. Again, just look at the last 2 quarters. Whether this trend continues as a result of COVID mitigation or not, I'm not sure, but I just thought I'd throw this up as some of you are certainly interested in gold production costs. One of the interesting things is, although investments are increasing, central banks are actually selling gold. So this is the changes in central bank holdings. You can see that basically this is we're actually seeing a lessening of demand from central banks over time. There's been some big purchases in the past, but it's not anything significant at the minute. But if this continues on down, then maybe the central banks will divest because of high prices, and other investors may buy. We'll have to see. It's an interesting time to be in gold, I think. If we look at platinum, again, we get quarterly data for platinum. I'm not going to go into this in a huge amount of detail, but it's an interesting contrast to gold. Here we have refined production. We have total demand up here. We have this is total supply because we've got essentially a lot of recycling going on in the platinum market, because catalytic converters are fairly readily recycled. But one thing to note is that total supply and total demand are both decreasing, probably because essentially people stop making cars. They're lessening the demand for platinum, and that's what's caused this kind of this move from a surplus to almost basically a significant change in demand. And this is all related to cars. It's the same as affecting palladium. What we've seen is this is just basically a futures prices. We've got a shrinking, this is passenger sales in China and Europe since January 2020. You saw a big slump around the pandemic, and they've actually increased. But this is what's causing this kind of price gap between palladium and platinum, because palladium is exclusively used in petrol or gas-driven cars, whereas diesels are used in used platinum. So that's why we get this change between the two metals, which are essentially, the supply is all essentially dominated by South Africa. So what does all that show? What does all that mean? We know that prices for all metals barring gold dropped about 20 to 40% because of the pandemic, primarily because of the decrease in demand. We see they've rebounded. Gold and palladium prices are significantly higher. Aluminum, platinum are slightly lower, but all these other metals we consider, cobalt, copper, nickel, lead, tin, zinc, they're all slightly higher than where they were in January. Metal stock data are limited, but we see there's more nickel, much more zinc, and less copper available for sale than in January. And what does all this mean? Are we actually seeing prices reflect supply and demand interactions or not? Certainly for copper, we think that's the case. There's a good correlation between copper stocks and prices. Nickel and zinc, there seems to be no correlation. So the prices are not reflecting demand variations. So the metal prices are being controlled by something else. And one question is, should we expect a correction in those prices of the nickel and zinc? The increase in nickel and zinc stocks in warehouses suggests demand has decreased, not made up ground. So this means that I would suggest tentatively that nickel and zinc are undergoing a slow demand growth scenario. In other words, the demand for these metals is slowing down, and that's that's why stocks are building up, and that potentially should drive prices for these metals down. In copper is different. The decrease in copper stock reflects challenges in the copper mining sector, increased demand for copper. We've all heard that it's good for, has antiviral properties, but I don't think that's meant people has gone, that the demand for copper has shot up as a result. But basically, what's going on with copper? What we've seen is recovery in autos and appliances, Chinese property, all of these things have increased copper demand. The supply issues in the copper sector, copper mine supply seems to be decreasing, but refined supply is increasing. So we get this demand supply gap going on in copper. And we also see COVID-19 impacting Chilean copper production. So this suggests that copper, instead of just having slow demand, you've actually got problems with the throughput of copper to market, and that means you've got this supply chain disruption scenario going on. And that alone, because essentially mines can't meet demand, might mean that copper prices are going to go up. And we're sort of seeing that at the minute, especially if supply is going down, if the stocks available for sale are going down, then surely the price must go up to meet it. But at the moment, we're not seeing that. Everything is just plateauing at the minute. Whether that changes soon, I'm not exactly sure. And this is just putting it in perspective. This is a copper for the last, well, back to 2008, before the global financial crisis. This is the copper price back to the global financial crisis. A real significant drop in the copper price. And here, this is the copper price related to COVID-19, the slump here, and the recovery to actually levels above that before the pandemic. So, you know, one of the questions is what happens after the pandemic, though. This drop here is not necessarily related to the financial crisis, but it's the European sovereign debt crisis that happened afterwards. The bailouts all cost money. So, you know, we are bailing out like never before over here. So what's going to happen to copper prices and other metal prices as a result? And certainly uncertainties equal volatilities, and that equals a drop in expected demand for metals. And lastly, there's a safe havens, gold and palladium. The latter is affected by increased demand for palladium in catalytic converters. That's why we've seen this huge increase in palladium price over the last few months and a couple of years, and restricted palladium supply. There's not many palladium mines out there. Gold prices have increased. We saw that after the global financial crisis as a result of ongoing economic issues. That gold price increase is likely to persist as long as the COVID-19 crisis continues. Probably afterwards, as governments deal with increased spending and debt. We saw that after the global financial crisis, debt is very high right now. But as I say, what's actually driving the price? Is it sentiment? Is it actual investment spending? But this seems to be counterbalanced by drops in jewelry. And if it's not actual spending, will gold prices decrease as a result? You know, how much is supply and demand balancing each other in these metal markets? And palladium and platinum, the other potential safe havens, they're much more dependent on cars, catalytic converters, but also you get restricted supply thanks to South African issues, the Bushveld, Witwatersrand, and so on. So there's a real interesting interplay going on in palladium and platinum, and also in gold. And as I say, watch this space to see what happens next. We know that a V-shaped recession is increasingly unlikely. We're not likely to just bounce back out of this. We're seeing a slow recovery after a sharp downturn. But we also, I would strongly suspect the outlook for different metal parts of the mining sector depends on the metal you're dealing with. And need more of a detailed analysis to determine impact on individual metals and byproducts. So it's not just the metals I've talked about here, but if we look at zinc, then you also need to consider, okay, indium, cadmium, and gallium. You know, all of those, if you decrease zinc production, it's going to decrease the production of all three of these metals. Who cares? Well, if anybody's using a touch screen right now, you care because you need indium for it. If basically we cut zinc production, we actually may run out of indium for our touch screens. It's a very drastic scenario, but you know, it's just an indication of the interplay we always have between different metals in these sectors. And the long-term prognosis is unclear. We need more research. Are we going to make less aircraft? Are we going to use more copper? Well, what's going on with medical consumption and the production of medical facilities and instruments? And low oil prices, again, is that going to increase the profitability of the mineral industry? You know, that's an underlying factor. An awful lot of fuel is used on mine sites. Fuel is cheap right now. Is that counterbalancing any changes we're seeing in metal prices? Although metal prices are not slumped. And the other question is, you know, COVID-19 trends, are they going to be short-lived, long-lived? How are they going to overprint existing trends? And when I talk about existing trends, I mean things like this. This is, you know, gold production, 1913 to 2013 and continuing on up here. You know, these trends are continuing, and these trends are present in any metal you look at. This is global gold, this is global copper from 1880 to basically 2015. You see, lo and behold, you know, we've gone from less than a million tons of copper a year to, well, probably more than 20 million tons of copper per year right now. You know, these are the COVID-19 might be one of these bumps in the road like this. This is but then again, we don't exactly know. We're having to wait and see how things pan out. There's some really interesting trends developing, but you know, how long those trends happen and whether all of a sudden we're going to see collapse in prices as a result of supply and demand, you know, re-equilibrating, I'm not going to predict. But I am just going to wrap up. Like other pandemics, there's a lot of risk to the mining industry. That risk we're starting to understand more and more because we're having to mitigate against it. Understanding the virus is key to understanding the risk. If we understand one, we understand uncertainty and can mitigate. We saw that with Ebola in West Africa. We're seeing that with COVID-19. Industries globally were put on hiatus, but then they restarted. And one question is, you know, is the globalization of industry and this interconnectivity good or bad here? Is it helping us or is it hindering us? Lots of uncertainty, but this drove the drop in prices and they've basically all recovered to either the same level or increased afterwards. And markets have been reassured by government packages of funding, approaches to dealing with the virus. But what about debt? Somebody has to pay for all of this afterwards, and what's going to happen then? So, you know, the question is what next? Seeing assessment and containment, slow reopening of industry, but what about demand? And demand is the key driver in this. You know, how many mines have been affected and things like this. There's no foolproof predictions here, but previous pandemics have indicated that change is going to happen, not necessarily in a negative way, but equally recovery is not likely to be rapid. Wait and see on the vaccines, I guess. But it's important to see what happens as countries come out of peak COVID periods and when they go back in again. You know, industries will reopen, but what about demand? And certain products have high demand, others will see decreases. And, you know, how long are these trends going to continue and how are they going to affect different parts of the mining sector? All of these questions still remain to be answered somewhat. It's a very complex picture. We're seeing the impacts might be less than the global financial crisis on the metal mining sector. There's no underlying financial issues right now. That may change. And the pace of bounce back and the actions of governments is going to determine how metal mining proceeds from here. But individual metals are behaving differently. So some metals seem to be following this persistent supply chain disruption scenario. In other words, they can't get metal to market. Demand, you know, there's an insufficient supply. There's an increased demand, so metal prices for copper might go up. A slow demand growth scenario for like nickel and zinc sees excess stock, excess supply, maybe a decrease in these. And we're seeing investment in precious metals like gold, which people traditionally have thought of safe havens, and that behavior is not changing. So certainly the outlook, as long as this crisis continues, maybe even further, if we get into a debt crisis, is good for those safe havens. Don't invest in the market based on that advice though, please. And there's much more to discuss in this area, much more we can talk about. It's an ongoing situation. It changes every day. But I think that's about all I've got on right now on this topic. If anybody has any questions, feel free to ask now. You can also email me, catch me on Twitter. I'm happy to send this presentation if anybody's interested in the other stuff we've been doing on COVID. But if anybody's got any questions, I'm going to stop sharing my screen and ask away.
Feel free to ask questions in the chat function, and thank you, Simon, very much for your presentation.
Donald, sorry, I was just going to say Donald Strachan mentions about COVID death rates. That's fine, but it doesn't really matter if a government wants to mitigate or a state wants to mitigate, it will. Death rates are somewhat irrelevant. So,
well, that's true, but I'm just wondering what you might think of the reaction of the states, the several states, or the federal government to if these death rate peaks become more known and people realize that death rates are flatlined.
Well, the latest I saw for this state is that they're going up again, but or at least that was hospitalizations. But what we should have done is we should have done what Western Australia did or New Zealand did and actually clamped down hard and fast and got it over and done with and then moved on. But we didn't do that, and so we're facing the penalty. And this is why, you know, this is why people are quite happily mining away in Australia. Maybe not in Melbourne, but there's not much mining in Melbourne. I think that I'm not going to speculate on what should have been done or what could have been done or what should be done now. I'm just going to focus on the mining industry.
Okay, I went up to Renown last week, and I went to their COVID-19 areas that they built up with federal funds, and they're all empty, and people just aren't reporting into the hospitals with any COVID-19 problems. And so our industry it seems to be doing pretty well in terms of mining and production. What do you think?
I think that's the case. I mean, but equally industry or certain industries have learned a lot from experiences with Ebola in West Africa. The mining industry there suffered huge losses as a result of the mitigation of that epidemic, but they learned how to cope with pretty nasty stuff. And I know some of the major mining companies with experience over there have just rolled out essentially the same things to keep on operating, which has meant they haven't lost like $500 million in revenue or so.
Yeah.
Elizabeth, fire hose of info. Yeah, that's what I got. I got comments like that from when I was submitted the paper to the SEG. Palladium popped up at the beginning of the year before March when all four plunged with a lockdown. That may have been reflecting things like just the increased demand for palladium. Palladium has been pretty hot for a couple of years now because everybody stopped making diesel cars. They've just gone back to petroleum, and the only metal like using those catalytic converters is palladium. So the car market has been really driving that up. So it may be that we're just seeing palladium prices reflecting that increased demand up until everything shut down. So palladium has a kind of double whammy. It's very much controlled by cars, but also it's seen as a safe haven and better than platinum these days by a lot of people. Although the World Platinum Investment Council don't like that. So I think that would be my take on it anyway.
Simon, I've got a question.
Mm-hmm.
And by the way, that was a great talk, very informative. I think there are way more questions that remain unanswered than, things that we really know for sure. And I guess that's where my question lies is, do you think we're still too much in the thick of it to really see the real patterns that are emerging, that the reason for the inconsistency between metals might be that the window's too narrow?
I think that might be the case. There's certainly, things are developing all the time. And because, mining is a global industry, it's not, most metals are mined all over the world. And I think it's an interplay between supply and demand, and that interplay often doesn't play out there's often delays. And I think what we might be seeing with those stock data is that there's some sort of delay going on and the prices haven't corrected as a result. I haven't, you could talk about all sorts of things like futures prices and what they mean and the role of hedging and things and all this, but then you just start to get into economics, and that's not my game. I like looking at rocks every now and again.
Very nice talk. Thank you.
No worries.
Any more questions? Here we go.
Recent article about Shell using pandemic as a driver on a source of peak oil production, diversify, major plans for diversification or changes beside automation. Maybe. I mean, it's difficult to know what companies are actually doing and what companies are talking about. Certainly, we've seen hydrocarbon industries move towards more renewables anyway, because consumer sentiment and large investors are just pulling away from fossil fuels. So if you can see that the kind of the Norwegian government sovereign fund, which was basically oil revenue that they're now refusing to put into oil companies. So I think I don't know about diversification or changes. I think the stuff we saw in May with and earlier with the oil side of things is Saudi Arabia and Russia playing chicken with each other in some ways and affecting the rest of the world. So I think whatever happens, the major oil companies that don't have access to the Saudis' constant well of oil may well think more about diversification in the future. On the secondary metals, no. I mean, they're still too minor. They're still too. A lot of them are still too. The prices are too volatile, and they're not big. They're not important enough for the major mining companies to get really interested in. There's some exceptions to that. Like Rio Tinto have a very large lithium deposit in Serbia called Jadar. But even they're pausing things because they want to see how the lithium market pans out. Because if they're seeing quite a lot of lithium production come on stream, and they don't want to swamp the market with this great big lithium deposit. So that there's some metals, some critical metals, secondary metals, which may become more important and maybe have larger, mining sectors develop. But a lot of them are still going to be very peripheral and not important to the economics of a given mine, unfortunately.
So Simon, you've obviously thought about this a lot. If a vaccine comes out in November that's fairly effective, and I expect that a vaccine might not be 100% effective. It might be like the flu where they have a guessing game every year. There's some uncertainty, but if that were to come out, what's your prediction on base metals overall, gold and silver, the precious metals? Obviously they're tied to different things, but gold is largely a doom and gloom metal, and so you might expect that vaccine would have a negative impact on the gold price.
It all depends what happens afterwards. So, I mean, I think the focus right now above everything else is getting out of this crisis. Resolving COVID-19 one way or another. If that's a vaccine, then so be it. But then all the stuff that's been happening during this pandemic is going to come home to roost. You don't spend $1 trillion lightly. That money comes from somewhere. That money needs to go somewhere. If you have linked economies like the EU, where some have spent more than others, then if they start to kind of have economic problems as a result of their debt again, then you might see gold prices zoom up as people go towards safe havens. It all depends on how things are managed, and that's not just the vaccine, but also how people manage their economies afterwards, and what people are how they're going to manage their debt. People are going to kind of just try and wipe it off, or are they actually going to start paying it back? I'm not a head of government, so it's not my decision to make. But I think even with a vaccine that's 100% effective, you get it to everyone. Basically, what you do is remove COVID-19. We can all go back to normal. But what about all this money we spent? And how quickly can we get back to normal and making money and making taxes? The government's can spend debt back, and I don't know. There's too much uncertainty. I think the safe havens are going to be safe havens for a while. Other metals, we have to wait and see. Copper might be good because it's got issues with supply, but the demand is still increasing. But other metals like nickel, that's used for steel making. If construction slumps, then nickel price will probably go down, and we've seen the stocks have remained about the same with zinc. So it's a difficult one to call, which is why I'm not a metal market person, an investor anyway. I don't have enough money to invest. I'm a professor at a university.
It may be that the vaccines will be a good excuse for our political masters to back off on the lockdowns.
I have to wait and see on that. I'm certainly not getting into predicting politics. It's hard enough predicting metal prices. So.
How about one more question for our speaker this evening? Or not.
I mean, if anybody wants any, I'd certainly refer you to the SEG Discovery publication. And I'm happy to share any of these data. I'm probably going to collate it and see what happens over the next few months. So if you want an update, I'll happily give you one.
All right. Thank you very much, Simon, for your presentation this evening. That was awesome. Super interesting as well. For those of you who are doing the GSN field trip, I will see you in a couple weeks up in the mountains, up the Shoshone Mountains. Thank Paleo West Archaeology for sponsoring tonight's meeting, and thank you to the 2021 GSN Symposium for co-hosting tonight. So with all that, everybody stay safe and see you next month.
Thanks
Bye,
very
Josh.
much.
Thanks, Josh.
Thank
Thanks,
you.
Simon. Well done.
Thank you, Josh
Thanks, Simon. Great talk.
and
Cheers.
Michael. Well done. Now, how do I get out of here?
Molly, you've got this recorded, okay?
I do. I've got it recorded. I'll let it compress here. I've got it recorded on this iPad and then on a laptop, so we should be good. I'll try and trim it tonight and get it to I'll get it to you, I guess, because it's got to go on your YouTube, and then we'll get it to D4.
That's good. And Simon, thanks again.
No worries.
Well done, Simon. That was great. We appreciate it. And